All right, welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo.
All right, we're recording on Friday, March 28th, 2025, 10:02 a.m. Pacific. Markets are kind of getting roiled a bit right now. As we sit here, the S&P 500 is down about 2%. Bit of a beat down. That leaves it down 1.44% on a week-to-date basis. Looking across the sectors, the tech sector is the biggest loser, down 3.5%, and that leaves it down 8.5% on the month and over 11% down on the year. So definitely tech still in the correction. Definitely a lot of news coming out of the kind of macro front, and a bit of a bloodbath here. Looking across other sectors of the equity market, communication services down about 1%. And industrials down about 1%, interestingly. Maybe some tariff talk spreading into there. On the bright side, though, consumer staples are up 2% on the week. So that's if you wanted to hide, that was one sector that's done all right. Real estate and energy are also up on the week. So that kind of rounds out the sectors, kind of digging into value versus growth. Values outperform growth, but they're both down. Values outperform growth by about 2%. And that's kind of interesting. Maybe a little bit of a value rotation going on in equities as fears materialize, but it's going to be tough to see what happens just by one data point. And then if we look at like small cap stocks, the Russell 2000's down about 2%. So roughly in line with the rest of the market regarding the depreciation. Interestingly, wasn't a week you could really hide in bonds. If you look at the performance of the Treasury curve, the 30-year Treasury is up about 5 basis points on the week in yield, and the 10-year is up about 1 basis point. So you could call that flat. The front of the curve hasn't changed much. But where does that leave you? Well, the U.S. aggregate bond index is down about 5 basis points, so much better than stocks. Okay, you're down 5 basis points. You could call that a wash. So your capital's been preserved there. Kind of digging into the sectors a little bit though. High yield bonds, with their equity beta, they're down 0.5%. And emerging market debt bonds are down about 60 basis points. One bright spot is government securities are up slightly incrementally, and mortgage-backed securities are flat. So, let's call those both flat. So, pretty interesting backdrop in fixed income. Not really a place to hide, but that said, I mean, you're seeing a rally at the back end of the curve today. And we're going to kind of digest some of the interesting economic data that came out. But, the long bond's up about 1 point and 10 years up about 1 point. So definitely a bit of a rally. Gold is really glistening. Gold has been a major winner on the week, up 2.4%. As we sit here, gold is trying to test the 3,100 level. It's at $3,085. So gold's really been giving people a place to hide. Bitcoin's actually down about 0.5% on the week. The dollar's flat. Commodities broadly are up about 34 basis points, with the best sector being precious metals, which makes sense. Energy also appreciated about 1%, but there's a lot of volatility there, so definitely can't really count on that. Industrial metals are down about 0.5%. And really what we've seen this week, in my opinion, is a lot of tariff talk of roiling the markets. The tariff talk has just really grown the first 2 months of the year, and we're approaching what President Trump calls Liberation Day, April 2nd. So, we'll see. Liberation from what is to be seen, but we're getting towards it, and definitely that volatility is being injected into the market as global business leaders, corporations, small businesses, and consumers all try and digest, are my cars going to go up? What's going to go up? What's going to go down? So this is kind of where we're at. What do you think, Ryan?
Yeah, I think you really hit the nail on the head with, markets really don't like this renewed tariff talk and, the potential negative impact it'll have on growth. And, You saw that in the equity markets, after a couple weeks of stability, you're starting to see the cyclical stocks really start to underperform defensive stocks, just really kind of downgrading that outlook on growth. And you're seeing kind of a similar theme play out on the yield curve, as you were mentioning. The front end has been a bit more stable, while the back end is sold off, I think, on a little bit more of budgetary concerns. So you actually saw like the twos 30s curve move to a new cycle high this week, which is kind of interesting and definitely something to continue to focus on in the rate markets. But on the
Yeah, I'm definitely something to keep an eye on. So let's just jump into the macro this week. Pretty interesting week. A lot of data dropped.
Yeah, that's right. I think this morning's data was probably the most impactful, but I'll go through chronologically because there were some interesting data points that were released earlier in the week. We started the week off on Monday with the S&P Global PMI, the preliminary March survey, and for it was a bit mixed for the US. So manufacturing that dipped back into contraction territory, which is below a 50 reading on the index. The number came in at 49.8, which was below expectations. But on the bright side, you had the services component, which represents a larger part of the economy, that came in stronger than expected at 54.3, so well into expansion, and that brought the aggregate PMI reading higher and above expectations. Then on the following day, on Tuesday, we had a read onto consumer confidence, which we've been highlighting has been deteriorating over the last couple months. So on Tuesday, we had the Conference Board consumer confidence reading for March, and that was well below expectations. The headline number dropped to the lowest level since January 2021. And that was really driven by a deterioration in consumer expectations. Consumers are really not thrilled about the prospect of higher tariffs and how that might feed into higher prices. Um, and that really had a negative impact. And you also saw consumer inflation expectations for the year ahead move up to 6.2%, which is a pretty shocking number, and the highest we've seen in a couple of years. And it's a similar theme that we've been seeing in the University of Michigan consumer sentiment data, which we also got this morning, which I'll highlight later. Then the following day, we had the durable goods orders, which came in better than expected in February. It was up 0.9% month over month. Economists were expecting a decline of 1%, so a pretty significant upside surprise there. If you look at core capital goods orders, excluding non-defense capital good orders in aircraft, that declined by 30 bips on the month, and core shipments that rose by 90 bips. And you're still seeing the level of orders, remaining above the level of shipments, which is a good sign for investment growth for Q1. So that's one bright spot there. Then we had initial jobless claims on Thursday. Nothing really to report there. It's been remarkably stable. The initial jobless claims number was at 224,000, which is right smack where the 4-week moving average is. But we did see continuing claims decrease by 25K to 1.85 million. We also had real GDP for Q4, the third revision there, so not really too market moving, but Q4 GDP, for what it's worth, was revised higher to 2.4% Q over Q annualized. And then the real data, I think the most relevant data for the week came out this morning with the PCE price data, as well as the personal income, personal spending data. And then later in the morning, we had the University of Michigan consumer sentiment data. So on the PCE price data for February, a couple weeks ago when we had the CPI and PPI data come out, we had highlighted on this call that the inputs that went into PCE were a bit hotter than some of the economists were originally modeling. So that pointed to the potential for an acceleration in PCE prices. And that's exactly what we saw. And if anything, it came in probably a little bit hotter than most economists were modeling. And for core it came in, it led to a round up on the, when you're rounding to the nearest tenth of a percent. So for the headline PC data, that that number rose by 33 basis points month over month. That was more or less in line with consensus, and that led to a stable year over year number at 2.5%. But on the more important core PCE number, so excluding food and energy, and this is the data point that the Fed pays more attention to, that rose by 37 basis points on the month, well above, what would be consistent with a 2% inflation target, but basically double that. And it was above the 30 basis point consensus from the market and an acceleration from
Now,
January.
what do you read into that? What do you read into that, Kimmel? I mean, what do you think the Fed's thinking right now? You think that they're quivering in their boots? You think that they're relaxed? They think that they're just chilling with the transitory mindset, or what's your attitude? What do you think Jerome Powell's doing right now? Drinking his coffee, listening to minutes, trying to glean some insights.
I don't think he's too excited about this number. It definitely doesn't help their situation. I mean, you're looking at, 3 month annualized rates at 3.6%. So it's moving in the wrong direction for them. And, this is before you're seeing any potential, positive impacts from the tariffs. So I can't imagine they're too thrilled with this number. The one thing that I will say is that at the beginning of the year in the first quarter, you do tend to see a bit hotter data that we've mentioned. There's like residual seasonality that's not being accounted for that leads to hotter prints. So, it does look like, and a lot of economists are forecasting that you might see some sort of deceleration in the data over the coming months, which will definitely help that year over year number. But by and large, it's not moving in the right direction, and you're probably going to need to see 2-3 months of zero point 0.2 month over month prints to get them kind of more comfortable with the trajectory of inflation.
Yeah, I mean, I agree. And then you look at like you look at the interest rate path and you look at like what the futures market is speculating and they still have three hikes priced in this year, but to me that's kind of more of like a bimodal distribution where you have like either a big recession, you have multiple hikes, or you have like the Fed is forecasting one or two cuts. Sorry, if I said hike, I was trying to say cut. And yeah, I mean it just looks like the chances of cuts in the face of these sort of prints is de minimis. You look at the chance of a cut in May is pretty much zero. Even in June, it's pretty low. So I find that kind of interesting. I don't know what your point of view is there.
Yeah, I think you're right. They're pricing kind of like the market at least is pricing in two different outcomes, like the non-recessionary view where maybe the Fed cuts 1-2 times, and then the recessionary view where they'll have to cut maybe by 100-200 basis points, and I think that's what you're seeing being priced into the market, and it's really there's a lot of it's very skewed to the downside, where if you do end up in that recessionary um, episode, it's really not gonna. I don't think the inflation data is going to really matter. It's really going to be where's unemployment, and I think the Fed will start easing accordingly if the unemployment rate starts to move higher.
Yeah. Anything else that popped out to you this week in the macro front that you think our listeners should be aware of?
Yeah, I'll just point out the University of Michigan consumer sentiment data that we got later this morning. That deteriorated. So this was like the second estimate for the month of March, and it was revised even lower. And I thought was interesting digging through the details of the report and some of the notes from the University of Michigan, they highlighted that 2/3 of consumers expect the unemployment rate to rise this year, in the year ahead, which is the highest reading since 2009. So, right coming out of the global financial crisis. So it seems like consumer sentiment is very low and diminished right now, which is definitely something to keep an eye on because that could have future impacts on spending. And then I'd also highlight the inflation expectations were also revised higher. You saw year ahead inflation expectations revised up to 5% this month, which is the highest reading since November 22. And then the long run inflation expectations, those revised higher to 4.1% annualized, which is a pretty shocking number. I know there is some political bias here, but the surveyors do mention that it was a pretty broad-based rise in inflation expectations. So definitely something to note going forward.
Yeah, I mean, it's definitely not a good number at all. I don't know how you can be pleased if you're sitting there at the Federal Reserve looking at those inflation expectations numbered. I mean, they always talk about how they want expectations to be well anchored. Well, that looks as pretty far from well anchored to me. But, it's volatile data, so they'll blow it off. They'll say, well, we can't just look at one survey, but definitely people are concerned, and it just augurs for rates not moving, and unless there's a big uptick in the unemployment rate, as we've already discussed. Kind of moving along to next week, it's a pretty light week, though Jobs Friday is a big thing. So I think that's the main thing for our listeners to keep an eye on for next week is Jobs Friday, where the unemployment rate is supposed to come in at 4.1%, steady she drifts, just same as the prior. I don't know. It probably will be that given the stability in the unemployment claims, but you don't know, what'll happen there. And it'll be interesting to look at the household survey versus the establishment and digest that. And we'll definitely dig into those details for our listeners next week. Labor force participation and unemployment are predicted to come in at 62.4% and 8%. So those are the main things to keep an eye on for next week, in my opinion. I mean, you'll get the jolts on Tuesday. You'll get the ISM manufacturing on Tuesday. So those could be some things to watch, especially given that, we got Liberation Day coming up after April Fool's Day on April 2nd. Wednesday, April 2nd is what Trump proclaims to be Liberation Day. I don't really know what that means, but I guess we're just gonna have to wait and see, like what tariffs stay and which ones don't. Maybe he'll just make all the tariffs disappear and everybody will be happy. I don't know, man. We'll just have to wait and see. So that's another big thing to watch on Wednesday, Liberation Day, and you get the ADP unemployment change, but I don't really. I feel like that report has a low correlation with the labor report on Friday, so it's kind of nothing really to see there. And that kind of that wraps it up from my point of view. Anything else you want to highlight, Brian?
Nope, I think next week will be interesting, as you mentioned. Got Liberation Day and payrolls for March. I think those are the kind of the two key inputs that investors are going to be watching.
Well, that kind of wraps it up for this week. So thanks to our listeners out there.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, you can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doubleline capital so you can check out all the latest content. I don't have anything to really highlight for you this week, so just maybe get caught up and buckle up and prepare for Liberation Day next week.
Take care, everyone.